In today's episode, I'll talk about three interesting stories. In the first story, I'll talk about HDFC Bank's latest quarterly results. Even though the results were technically bad, the stock price went up. We'll understand why. In the second story, I'll talk about quick commerce and why Kirana stores are worried about it. And in the third story of the day, I'll talk about a new liquidity window that has been introduced in the bonds market of India. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest stories and news in the financial markets in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 22nd of October. Let's begin with the first story. Look, HDFC Bank is known for many things, but one thing that has always stood out is its consistent high loan growth. For many years, it was almost like a rule. HDFC Bank would always grow its loan book by about 20% every year. But something surprising has happened in this quarter of FY 2025, which is July to September. HDFC Bank's loan growth slowed down to just 7% year on year, which marked the first time in many years in which HDFC Bank's growth has slipped to single digits. Now, if you are familiar with HDFC Bank or you have invested in the stock, you're probably thinking at this point, something might be wrong, right? A drop like this could easily raise red flags. But the interesting part is the market did not panic here. In fact, the bank's share price went up by about 2.5% immediately after the results came out. So the question is, what exactly is going on? Look, to understand what is behind the scenes, we first need to look at the merger between HDFC Limited and HDFC Bank. See, HDFC Limited, which is a housing finance company, was the parent of HDFC Bank. On 1st of July 2023, the two companies officially merged into one entity, which created a financial giant, so to speak. But this merger was not just about making the bank bigger, it also somehow complicated the bank's operations, especially in terms of its balance sheet. Look, when HDFC Bank merged with HDFC, it did not just gain assets, it also inherited all the liabilities or debts from HDFC Limited, and this changed the bank's balance sheet almost overnight. Now see, banks typically fund themselves in two main ways. The first one is deposits, which are the savings and fixed deposits which customers leave within the bank. Now these are the preferred source of funds for banks because they are relatively cheap. Customers are more focused on safety than returns, so banks can offer relatively low interest rates here. The second source for banks is borrowings, which is the money that a bank raises from the market, which is usually raised through bonds. Now, borrowings are a more expensive mode since investors expect higher rate of returns. Now, coming back to the story, before the merger, just 8% of HDFC Bank's liabilities were borrowing and the rest came from deposits. But after the merger, borrowing shot up to 21%. So in simple terms, for every 100 rupees that the bank owed, 21 rupees now came from borrowings as compared to just 8 rupees before. Now this shift directly impacted two very key financial metrics. First is the cost of funds, and second is the credit to deposit or the CD ratio. Let's talk about this a little bit first, starting with cost of funds. See, this refers to how much it costs the bank in order to raise money. Since borrowings are more expensive than deposits, HDFC Bank's cost of funds increased from 4% to 4.8%. The second thing which I mentioned was CD ratio or credit to deposit ratio. Look, this ratio shows how much of the bank's deposits are being used for lending. After the merger, the bank's CD ratio jumped to 110%, which was up from about 86 to 87%. Now, this means HDFC Bank was lending 110 rupees for every 100 rupees in deposits, essentially relying heavily on expensive borrowings to fund its loans. Now, the thing is, a CD ratio above 100 is not quite ideal because it means that the bank is lending more than it is collecting in deposits, like I just mentioned. This exposes the bank to liquidity risk, which is the risk that it will not have enough cash on hand in order to meet any immediate obligations if the economy takes a turn for the worse or if deposits start to dry up. Now, to avoid all of this, bringing CD ratio down has become a priority for HDFC Bank. To manage this shift and ensure stability, HDFC Bank is implementing a three-part strategy. The first and the most noticeable change is that the bank is intentionally slowing down its loan growth. The company's CEO, Shashidhar Jagdishan, has outlined a plan to grow deposits faster than loans over the next few years. In the most recent quarter, HDFC Bank actually reduced its wholesale loans, which are those to large corporations and businesses, showing a more cautious approach. Now, retail loans, which are those to individuals like you and me, are also growing more slowly now, while commercial and rural banking remain a key focus for HDFC Bank. The idea for them is to grow conservatively in FY 2025, match the market in FY 2026, and then aim to outpace competitors by FY 2027. And the reason they're doing this is because this gives them time to adjust to the merger without sacrificing any long-term growth potential for the company. Now, at the same time as all of this, HDFC Bank is also working hard in order to grow its deposit base, which is a cheaper and a more stable source of funds than borrowings. Now, to do this, the bank is aggressively expanding its branch network. They have opened 241 new branches in the last one quarter alone. This effort is paying off as deposits have grown by 15%, outpacing the industry average as a whole. The goal for them is to bring CD ratio back down to pre-merger levels of around 85 to 90%. Another tactic that HDFC Bank is using here is securitization, which in simple words is selling off some of its loans to external investors. By doing this, the bank can free up some capital and reduce the size of its loan book. This lowers the CD ratio and improves liquidity and gives the bank a little more flexibility in order to manage its cash flow. And if you're wondering, these strategies have already started to yield results for HDFC Bank. For the first time since the merger, HDFC Bank's CD ratio has dropped below 100%, which is a major milestone. HDFC Bank aims to bring it down to pre-merger levels within just 2 to 3 years, which is faster than they initially expected it to be. And therefore, despite slower loan growth, investors are reacting positively to this. The disciplined long-term strategy seems to have reassured the market, with the bank's share price rising 2.5% after the Q2 results were announced. Now let's move on to the second story of the day, where we'll talk about quick commerce versus the government versus Kirana stores. Look, in recent years, as you might have already noticed, India has seen a really rapid rise of quick commerce. Companies like Swiggy, Blinkit, Zepto, etc. are now delivering groceries and everyday essentials in as little as 10 minutes. Now, this kind of fast delivery has quite changed how everyone shops around us. Instead of planning our purchases in advance, many of us now rely on these services to get whatever we require instantly. But the thing is, this growth in quick commerce is also raising some concerns, especially for small traditional retailers, particularly local Kirana stores. Now, these local shops are feeling quite a lot of pressure because they are finding it hard to compete with big tech-driven companies which offer ultra-fast deliveries at lower prices. To give you some context of how big a threat quick commerce has become to Kirana stores, by 2027, the quick commerce space is expected to be worth more than 1,80,000 crore rupees. People seem to have gotten addicted to the ease of ordering whatever they need and having it delivered almost instantly, especially at competitive prices. And because of this unreal growth, traditional retailers and even the government are now raising some alarms. One of the key voices here is the All India Consumer Products Distribution Federation, or AICPDF. This group represents around 4 lakh small shop owners. They believe quick commerce companies are engaging in something called predatory pricing, which is a strategy where companies sell products below their cost, forcing out smaller competitors out of the game. They believe quick commerce companies are engaging in something called predatory pricing. Now, this is a strategy where companies sell products at below cost, which forces out smaller competitors. The AICPDF has now taken this issue to the Competition Commission of India, or the CCI, and they are accusing companies like Swiggy, Blinkit, and Zepto of driving small Kirana shops out of business by offering prices that are unsustainable for smaller retailers. The Federation is fearful that if quick commerce companies continue unchecked, the retail landscape in India could shift dramatically and these large players could gain even more market control. Now the thing is, if the CCI investigates and then finds evidence of predatory pricing, these quick commerce companies might have to rethink how they price their goods, which could potentially slow their growth and give smaller businesses a better chance to compete against them. Another aspect of all of this is the growing use of dark stores, which are essentially small warehouses which quick commerce companies use in order to facilitate ultra-fast deliveries. The government is scrutinizing whether these companies are actually adhering to India's FDI or foreign direct investment rules in how they set up and manage these stores. To help you understand this issue a little better, I'll explain India's FDI regulations which are applicable here. First, foreign-owned companies are not supposed to directly manage or own inventory in online marketplaces. They are meant to be intermediaries which connect buyers and sellers and not as retailers themselves. Now, to comply with these regulations, quick commerce companies are claiming that their dark stores are owned and operated by separate entities. But the thing is, these ownership structures are a little unclear and complicated right now. So, this very lack of transparency raises some concerns from the government's point of view. Now, while quick commerce firms technically do not own the products or the dark stores directly, their close working relationships with these separate entities in a way blur the lines of control of ownership, which, so to speak, violates our FDI rules. Now, if you're wondering, this scrutiny is not really new in India's digital retail space. We've seen some similar issue with major e-commerce players like Amazon and Flipkart before, which have both faced acquisition of controlling inventory through third-party sellers in ways which sidestep FDI rules. To give you an example, Amazon's relationship with Cloudtail, which is one of its biggest sellers in India, has raised concerns in the past as well. Although technically a third-party seller, Amazon's joint venture stake in Cloudtail had a very significant influence on pricing as well as availability, which critics said violated the spirit of FDI rules. Flipkart also had a very similar arrangement with WS Retail. Now, both of these companies had used these very partnerships in order to offer deep discounts, which made it tough for smaller competitors to even survive in the market. Now, in response to this, the Indian government at that time had tightened e-commerce rules in 2018 and 2020. These changes had forced Amazon and Flipkart to revamp their business models. But even after that, concerns about their market dominance have not quite fully disappeared even today. So that said, then the question is, what really is next for quick commerce and what really will happen? See, as quick commerce is facing increasing scrutiny, the sector may be at a bit of a turning point. If the CCI does decide to investigate and finds these companies guilty of either predatory pricing or violating FDI rules, their operations could very significantly have a change. Like I mentioned earlier as well, Commerce Minister Mr. Piyush Goyal has been openly critical of business models which rely on offering deep discounts while incurring massive losses in order to gain market share.
If you make 6,000 crore loss in 1 year, does that not smell of predatory pricing to any of you?
His concern is that this practice is unsustainable and also creates an unfair competition, especially for smaller businesses which simply cannot afford to compete at those price levels. So eventually, how the government and the CCI respond to these concerns will pretty much shape the future of quick commerce in India. With small businesses hanging in the balance, so to speak, this is definitely a space worth watching closely as an investor. Let's now move on to the final story of the day. See, SEBI, which is India's market regulator, has recently introduced a new liquidity window for corporate bonds. Now, I know that might sound a little technical to you, but it's actually pretty straightforward and it could have a very big impact on how corporate bonds work in India. So let me explain what this is and why this really matters. See, for starters, corporate bonds are a way for companies to borrow money from investors. Think of it like lending money to a company. In exchange, they pay you interest and promise to return the full amount when the bond matures. But the catch here is, if you want your money back before the maturity date, selling your bond can be a little tricky, especially if the demand for it is low. This is exactly where SEBI's liquidity window steps in. It introduces a new option for bond issuers to offer something called the put option. Essentially, this gives investors the right to sell their bonds back to the company even before they mature on specific dates. I'll tell you how the liquidity window exactly works in practice. See, first, companies can choose whether or not to offer this put option. If they do, they must set aside at least 10% of the total bonds for this very liquidity window. Second, the company can open this option on a monthly or a quarterly basis, which gives investors some flexibility when deciding to sell their bonds back. Third, the price at which investors can sell the bond is not quite fixed. It is based on the bond's value of the day before the liquidity window opens. The company cannot offer to buy the bond back for more than 1% less than the valuation. Plus, any interest earned but unpaid is added to the sale price, so investors don't lose out on the interest as well. Fourth, this window remains open for 3 working days, during which investors can sell their bonds. But in this case, if too many investors opt to sell and the company cannot really buy them all, they will be bought back proportionally. Now, this means every investor might only sell a small part of their bonds. Now, at this stage, if you're wondering why exactly is SEBI introducing this and why does it matter for you as an investor, let me explain this by taking a closer look at the bigger picture of India's corporate bond market. Look, over the last decade or so, India's corporate market has grown very, very rapidly. Back in 2014, the market was valued at around 15 lakh crore rupees. And by 2024 now, it has grown to over 47 lakh crore rupees. This means it has more than tripled in size in just 1 decade. But the more important thing here is that the way the companies issue bonds has changed quite a lot over this particular time period. Back in 2014, around 12% of bonds were issued through public offerings, which means anyone could buy them. Today, that number is just 2%. Today, nearly all bonds, which is about 98%, are issued through private placements. This means bonds are sold directly to institutional investors like banks or mutual funds, and they skip the public process altogether. Now, while this method is definitely cheaper and quicker for companies, it also leaves retail investors with fewer options to buy these bonds. Now, even though the corporate bond market has grown quite a bit, there has not been a matching rise in bond trading. The daily average volume has hovered between around 5,400 crore rupees and 6,000 crore rupees since 2018, despite a 72% increase in bonds issued. This means liquidity remains a big challenge. So this is a concern for investors, especially retail investors who may need to access their money a little more urgently than larger institutions. And if it is hard to sell bonds, people are less likely to buy them in the first place, right? SEBI's liquidity window is a direct response to this very liquidity challenge. By giving investors the option to sell bonds back to the issuer at specific times, it creates an exit route. The extra layer of security makes corporate bonds a little more appealing because investors then do not have to worry about getting stuck with a bond that they cannot just sell. By the way, this liquidity window is not the only thing that SEBI has done right now. They've also reduced the face value of privately placed bonds from 10 lakh rupees to 10,000 rupees. Now, this change opens the door for more retail investors who were previously priced out. Additionally, SEBI has also introduced the request for quote or RFQ platform in order to make bond trading a little more efficient. This platform allows brokers to help retail investors connect with bond buyers and sellers very easily, which makes bond trading overall quicker and a little more transparent. So if you are an investor who is interested in bonds, these changes are great news for you. The liquidity window adds flexibility, the reduced face value makes bonds more accessible, and the RFQ platform makes trading a lot more smoother. So in short, SEBI's reforms are making India's corporate bond market a little more investor friendly than they were ever before, and especially for retail investors. Whether you're a seasoned investor or just getting started, it does not matter. These updates could make bonds a little more attractive as part of your portfolio. Now let's move on to the final section of the day, which is the news tidbits. First, Adar Poonawalla will acquire a 50% stake in Dharma Productions for 1,000 crore rupees. This partnership is aimed at expanding content production for digital platforms, which targets both local and global audiences. Second, Prestige Estates is investing 7,000 crore rupees to develop a 62.5-acre township in Ghaziabad. This marks their entry into the Delhi NCR market as well. The project is called Prestige City and it is expected to generate over 10,000 crore rupees in revenue. Third, Navi Finserv has cancelled its 100 crore rupees bond issuance. This comes after RBI's crackdown on high-interest loans, which highlights regulatory risks for NBFCs. This move is likely to affect Navi's capital raising and growth plans. Fourth, Sunil Bharti Mittal of Bharti Enterprises or Airtel has called for one more telecom tariff hike. He has pointed out to rising operational costs and he also stresses on the need for better digital infrastructure. According to Sunil Bharti Mittal, India's low revenue per user as compared to global markets remains a very big concern for them. That's all the news and stories I have for you today. I hope you found value in this episode. If you made it this far in the episode, do make sure you leave a comment down below giving us feedback or just telling us how you found this episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer, this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.